main thing that we want from a governance system is making good decisions, and people showing up is actually a cost, right? Like ideally, like the best scenario is we make all the right decisions and just one person shows up and has to spend like the least amount of effort making that decision. And the problem, like why we want voter turnout in a voter-based system is because, as Nick alluded to, like you can get capture otherwise, right? If I have 1% of the supply of a token, it can be in my interest to do capture. Maybe is best illustrated by like the 51% attack, right? If I have 51% of a token supply, I may benefit from voting myself like the whole treasury, even if it's not in the interest of the DAO, because like if I say it's like a $10 million treasury and then I have 51%, so like 5 million tokens, $5 million worth of tokens, like even if I completely nuke the DAO, like I would benefit $10 million by voting the whole treasury to myself.
I mean, this is why you have people like myself who look at the DAO once a week, at least, right? It was literally, it's an apathy attack. This has been done a couple of times. Very similar one happened with Compound a couple of years ago, where someone called Humpy turned up. And that was largely because they knew that the DAO was largely governed by blockchain clubs in universities. And they did it when they were all on holiday. And they managed to bought their tokens knowing that the blockchain clubs weren't around to defend it. Similar thing. It was literally, an attacker has seen no one's looking at this thing. It's largely been abandoned. All I needed to do is buy these tokens and put it through. It kind of high risk play, really, because they were betting on simply no one just looking at it. And it did have a time lock, actually. It did have a 1-day time lock, whereas 2 is a bit more advisable.
And I actually saw this play out in a job that I had before I went to the Treasury Department. I worked at Riot Platforms. Some of your audience may know Riot. It's a Bitcoin mining and AI HPC company. When I was at Riot a few years ago, we were building a data center in Corsicana, Texas. Everything was going swimmingly. It seemed like the community was on board until they weren't. Out of nowhere, there was a lot of Facebook opposition to the data center that was being built. And we traced exactly where this opposition was coming from. As it turned out, it was coming from an environmental activist who didn't even live in the city. She came from the city next door. And we looked into what she was doing and her background, and we realized that she had actually partnered with Greenpeace, which at the time Greenpeace had received a huge infusion of cash from a rival cryptocurrency to Bitcoin. That the explicit purpose of this Greenpeace movement was to FUD or cast fear, uncertainty, and doubt on Bitcoin itself. And so from that experience, that's when I realized we need to follow the money. And in doing so, I was able to translate that follow the money ethos to this national project we're doing right now.
What continues to bother me is that it's very easy to feed into this natural fear of technology that many people have, this natural fear of change. And you see across crypto, across AI, like the people who should be supporting this technology the most are fighting it. And who am I talking about? I'm talking about the progressives. Like crypto on its face is the most democratizing approach to finance you could have. It gives people real-time access. And yes, there need to be client protections, but it's a very progressive technology. AI is absolutely leveling the playing field overnight when it comes to information and education. It's a huge opportunity for people who have not had access, who haven't had the opportunity for on-the-job training because they didn't know somebody. So this is very progressive technology. And so it's just crazy, like when you see some of those progressive technologies coming out with this incredible progress, some of the progressives saying, no, we don't like this because it's dangerous. I think we've got that backwards.
So the president now has greater leverage over commissioners who are already serving. So if you have a commissioner who, the president thinks is blocking the administration's agenda, the president now has significantly more ability to replace that commissioner with someone who is more aligned with his administration's priorities. So what that means is agency policy, right? So everything from rulemaking and enforcement priorities to granting exemptive relief, that can all become much more closely aligned with the White House. And these things could potentially change a lot more quickly from one administration to the next. So I think what you'll see happen is that presidential elections will now have like a much more immediate effect on crypto regulation and just like regulation in general, right? So instead of waiting years for agency leadership to gradually turn over when commissioners' terms expired, a new administration could come in, replace, all the commissioners, presumably, and start like reshaping regulatory policy from like very early on. So I think like that could potentially have like a really big impact on policy.
What changed is the distance between having the information and being able to act on it, because like the more you understand agents and loops, the better you can get at making it work for you. And this was not just like one fighter here and there using a chatbot. They have decided to devote significant resources to build an industrial operation where they have specialist AI units, some of them who just sit in vehicles near the front trying to figure out how to make the next move. So they are doing AI governance in a way that like a lot of startups should be doing, but in a horrible, like the worst possible way. And they're learning how to do all this through jihadist networks. So like terrorists can talk to each other and share information, and they were trained by other terrorists, right? So you may have heard that LLMs have these safeguards, right? Like if you ask about a weapon, it will say, no, I can't answer that. Those are super easy to get around.
And I think we've talked about this in the past, but if we haven't, it's important. But Section 230 is a foundational law from the 90s that shields websites and online platforms from liability for content posted by third parties. It gives them good Samaritan immunity to remove bad stuff in good faith, which means like, okay, there's sex trafficking on Facebook. We know this, okay? But Facebook can't be sued for doing so, and Facebook is trying to remove that material, but they're clearly not getting it all. They're not even coming close, but they can't be sued because of Section 230. There is no Section 230, and Section 230 is controversial. Like it may be overturned at some point. But there's no Section 230 equivalent for crypto. I've said for years, if only there was, like from the chain perspective, that would be incredible for crypto. But the background of Section 230 is it was passed at a time when legislators actively wanted to support the internet.
Heads up everyone, we've now fully transitioned Bits and Bips to its new dedicated channels. So if you're not yet subscribed to the new Bits and Bips channels on X, YouTube, Spotify, Apple Podcasts, or wherever you get your podcasts, go there and subscribe now. For the next few weeks, we'll play segments of the full interviews on Unchained as a reminder, but for now, you'll only hear those short segments of Bits and Bips on Unchained, no more full episodes. You can get links to all of the dedicated channels with the full episodes at unchainedcrypto.com/bits and bips, spelled BIPS. Thanks again. If you hold crypto on your phone, your biggest vulnerability isn't your wallet, it's your carrier. AT&T, Verizon, and T-Mobile have been breached again and again, and SIM swaps are still one of the easiest ways for attackers to drain accounts. That's where Cape comes in, America's privacy-first mobile carrier. Same premium service, but Cape rotates the identifier on your SIM every 24 hours, deletes your call and text metadata after a day, and protects against SIM swaps with a 24-word recovery phrase that only you control. You also get 2 middle-to-end encrypted secondary numbers for banking and signups, so you stop handing your real number to every app that asks. Go to cape.co/unchained and use code UNCHAINED for 33% off your first 6 months. Fidelity has been researching and investing in blockchain since 2014, long before it was a headline, and they're hiring crypto and DeFi professionals to join their team and discover what's next in finance. Fidelity is looking for people with fresh perspectives from different backgrounds, whether it's tech, UX, or product design, whether you're crypto savvy or crypto curious, as long as you have the passion to make a real impact at a company striving to make finance accessible to all. Explore crypto careers at Fidelity today and make the decision that could change your future for the better. Visit crypto.fidelitycareers.com to learn more. That's crypto.fidelitycareers.com. Fidelity is an equal opportunity employer. Before we dive back in, a quick word about something we make ourselves. If you like the way we cover crypto on this show, clear-eyed, no shilling, just what actually matters, you'll like the Unchained Daily. It's our free newsletter that lands in your inbox every weekday, with the most important stories in crypto written by journalists, not marketers. No jargon, no hype, no number go up cheerleading. Just the news you need to stay ahead in the time it takes to drink your coffee. Subscribe for free at unchainedcrypto.com/newsletters.
MetaDAO has a pretty opinionated take on this, which is that voting doesn't really work. and that you need an alternative, and we use decision markets. I mean, I guess to break apart the problem, voter turnout is not intrinsically an issue, right? The main thing that we want from a governance system is making good decisions, and people showing up is actually a cost, right? Like ideally, like the best scenario is we make all the right decisions and just one person shows up and has to spend like the least amount of effort making that decision. And the problem, like why we want voter turnout in a voter-based system, is because, as Nick alluded to, like you can get capture.
All right. Hi, everyone. Welcome to another episode of Bits and Bips, the interview. My name is Steve Ehrlich. I'm the head of research at SharpLink, and as always, your host. And here today to talk about what's so far been a really great week. In fact, it's been crypto's best week in months. And my guest today spends his days looking past the price to the flows underneath it and really understand. We're going to try to answer one central question. Should we buy in, or is this going to be another kind of sort of relief bump? So, but before we get into it, as always, just a little bit of housekeeping. Nothing that you see or hear on this program should be considered investment or financial advice. For full disclosures, please see unchainedcrypto.com/bits and bips. And also just one other quick piece of housekeeping. Heads up, Bits and Bips has its own channels now, separate from Unchained. So if you're not subscribed on the new dedicated channels, you're going to stop seeing these episodes. Don't lose your regular dose of the sharpest takes in crypto. Subscribe on the Bits and Bips channels on X, YouTube, and your favorite podcast platforms right now, so every episode keeps showing up in your feed. Now, let's hear from one of our sponsors before I bring in our guest.
This episode is brought to you by Cape, America's privacy-first mobile carrier. Same premium service you'd expect from any other carrier, but designed so your number, your location, and your data actually stay yours. Get 33% off 6 months at cape.co/unchained. Heads up, everyone, we've now fully transitioned Bits and Bips to its new dedicated channels. So if you're not yet subscribed to the new Bits and Bips channels on X, YouTube, Spotify, Apple Podcasts, or wherever you get your podcasts, go there and subscribe now. For the next few weeks, we'll play segments of the full interviews on Unchained as a reminder, but for now, you'll only hear those short segments of Bits and Bips on Unchained, no more full episodes. You can get links to all of the dedicated channels with the full episodes at unchainedcrypto.com/bits and bips, spelled BIPS. Thanks again.
All right, welcome back. So I am very pleased to bring in my guest today, a repeat guest, a friend of mine, Andy Baehr. He is the managing director of asset management at GSR. So welcome, Andy.
Great to see you again, Steve.
Yeah, good to have you here. And you're the perfect guest to have this week because, as I said in my intro, in my opening, crypto has had its best week in months. People are feeling bullish. Bitcoin's been pushing up against 65,000. ETH is starting to set its sights on 2,000 again. And it all really, I think, comes down to one number, 3.5%, specifically the June CPI. And it's down from the year-on-year rate of 4.2%. And core has been flat month over month for the first time in 5+ years as well. So this is 3.5% is not any number to write home about, but at the same point, and it's far off the target of 2%, but it's gone down. And there's been a bit of a relief rally. That said, I think the question that I want to pose to you first, and I'm sure everyone has been kind of weighing themselves, is what to make of this, because again, it seems like there's a lot of reasons why CPI went down seem to be one-offs. I don't necessarily expect that to happen again when we get another reading next month. And although it appears that sort of the proclivity for a rate hike during the next FOMC meeting next week could be off the table because of this, Kevin Warsh also said in congressional testimony that I think his exact phrasing was inflation was a choice, meaning that like he's still committed to being hawkish if he needs to be. So what do you make of this? Like what is it just as simple as a relief rally, or are there bigger trends underlying that are worth pointing out here?
Yeah, it's a great question. There's a lot to unpack there. I think it feels, especially given all of the ambivalence, and that's the word that we've been using to kind of tag the market conditions through most of the second quarter, even at the end of the first quarter. Ambivalence not meaning the market doesn't care what it's doing, but that it will have these pulses of what appear to be, well-fueled rallies. You even start to see a little bit of energy returning into the perpetuals market, and then suddenly that rally kind of dissipates very quickly, and then there's a liquidation, and we're back to where we started. And that happened with Bitcoin in the high 70s, getting through into the low 80s around the time of consensus in the springtime. And then we had that kind of shunt down to the low 60s, down to sort of the production level of Bitcoin, which actually did bring some energy back to the market. But we're still in this kind of ambivalent phase, right? Where I guess the opposite of ambivalence is conviction, where you can reliably depend on these rallies to continue and to really create a different momentum cycle. So I guess, to phrase your question in another way, is this another ambivalent sort of single booster rocket rally where there's no, rocket to follow once the booster rocket is expended? Or is this where we begin to get legs? I think, zooming out, the best thing that feels comfortable to say is that we're in an environment where we don't know where peak hawkishness is in terms of market sentiment, right? It hasn't been really since like 2022, pre-FTX, when the Fed hiked very aggressively to sort of burn off the fiscal stimulus after COVID, right? And of course, crypto assets were very challenged, as were equities in that environment. Why? Because we didn't know what peak hawkishness was going to be, right? So think of it seasonality, right? We don't know when the Fed solstice is going to be, that moment at which we kind of really collectively feel comfortable that we know when the hikes are going to end. And it doesn't help, of course, that we have a new Fed chair and one who, we're not that familiar with yet, but certainly one who doesn't seem very comfortable or very eager to sort of, kind of soothe us, right? So I think until you really collectively, globally reach this kind of idea of this, what I'm thinking of as the Fed solstice of peak hawkishness, and you can sort of see over the crest of the hill to what might unfold beyond that, it's very difficult to feel like any kind of rally is going to be reliably sustainable.
Yeah, and there's a lot to dive into on that answer. So let's try to break it down piece by piece. One just quick answer, or one quick question to follow up, because I don't think you and I have really had a chance to speak about Kevin Warsh since he was confirmed as Fed chair. But I mean, he doesn't want to give out forward guidance in sort of the same spirit as Ben Bernanke or Jerome Powell, et cetera. And he's not issuing his own dot plot. I mean, he really wants the Fed to be, I guess this is praiseworthy, reactive to the data. And I have some sympathy for the Fed giving this forward guidance, because I think in some ways it was then stepping into a void that was abdicated by Congress. But that's a whole nother story. But I mean, what do you make of him as a Fed chair in a moment like this, where on the one hand, I guess it could be somewhat soothing to markets that he is sort of striking his independence. That whole inflation is a choice phrase is one that I think history books will be written in history books 10 to 50, 100 years from now. But at the same point, he has a president that wants lower rates and this inflation print, even if it is, I guess, quote unquote, the reasons for the decline are one-off, it could lead to some competing priorities. So what do you make of him?
I'm far from the greatest or the most skilled Fed watcher or or Fed whisperer, but it's pretty clear that you don't have a sycophantic Fed chair, right?
Mhm.
You have one who is declared in bold print, right, that he's going to be independent and not necessarily aim to soothe the market nor overinform the market.
Mhm.
Even if he were, right, it's a new relationship with the world and the Fed chair, and that's always a special time, right? He also has a very, not the simplest set of circumstances to work with here. When you've seen the gyration of
Yeah.
things like energy prices, which have now subdued, but could reinflate very quickly given the geopolitical situation.
Mhm.
So I don't know, right? And I think few people feel very comfortable except that they have a sense, and it's priced into into interest rate futures, and that there's very likely hikes coming up, whether they're sooner or later, whether we can delay them or how many there will be, we don't know. But we know that we're in this uncertain, kind of heightening cycle, and we don't know where it ends.
Yeah.
And that's where I come back to when we really collectively get to this comfort point of being okay. We've reached peak hawkishness. The sentiment will. I think the sentiment can shift very quickly. Let's remember, right? This all comes down to two things with respect to Bitcoin in particular. Bitcoin is looking at inflation expectations and it's looking at nominal rate expectations, right? And just like in 2022, when the nominal rates kind of accelerated so quickly that they just blasted past inflation expectations, that was very difficult for Bitcoin, right? Because
Yeah.
that kind of expected real rate, right, was going higher. When we get to the point where expected real rates can be understood better, that forms, I think, a better macroeconomic support for Bitcoin, but also just more generally, more practically, it will form a better sense of what financing is going to be like in fiat terms,
Mhm.
to basically provide more leverage into the crypto system, which it desperately needs to regain some of the volatility and energy volume that has declined since last October.
Yeah.
So it all really comes down to rates. And I have a lot more ideas about rates that I hope we can cover today. But in the zoom out phase, and I really, looking at crypto and anything more condensed than quarters for me is very, very difficult. But I do think that all of that adds up to learning and collectively getting to that point of max hawkish, reaching that summit of max hawkish sentiment, and seeing the other side of the hill.
Yeah. And I guess within the spirit of that max hawkishness and trying to, I guess, maybe read some of the tea leaves in the equities markets, I'd love to get your thoughts on just sort of some of the rotations that I'm seeing, and I'm sure you are too. Sort of the Mag 7 stocks continue to struggle, but the AI ones are going gangbuster, and we're seeing a real rotation into like smaller businesses, more cyclical stocks, like the Russell 2000 is doing extremely well. What do you like? What do you make of that, and how does that sort of like impact your view of risk sentiment right now? And this will kind of lead into our discussion about crypto and sort of like how we're seeing some of those larger assets divide.
I do think it's quite curious, and by professional choice, I'll spend more time looking at I think crypto sectors
Mhm.
and crypto I guess market cap sizes than equities. But you can't help notice this kind of Mag 7 volatility versus other sectors which seem to catch a lot of energy, and you just wonder whether that's just and I think even the last time we were speaking on this program, right, this kind of topic was coming up about unanticipated equity rotation. It actually makes me think about how crypto performed in Q2, where, as bad as it was, right, you had actual outperformance of small cap crypto relative to Bitcoin, Ether, Solana,
Mhm.
right, XRP, which is startling, right? In my old job, we built this index called the CoinDesk 80, which is kind of a mid and small cap index that starts at sort of token number 21 and goes down to 100. In any kind of healthy or even stable neutral market condition, you can rely on large cap cryptos to sort of pull away from small cap crypto. It just means that there's a collective attention on those larger liquid names, and over time, that's a pretty reliable indicator of a normal market. So to see in such a you might have situations in a sudden uptrend of small caps gaining a lot of energy and briefly outpacing kind of lower volatility Bitcoin, Ether, Solana, but normally over time you're going to have those sort of mega caps sort of pull away. So in Q2 to see that in Ether, right, was down less than Bitcoin is really kind of stunning, and it just showed how much evacuation there was from those majors in ETFs, in perps markets, in spot markets, in digital asset treasuries like your own, and to me, is that capitulation level towards the end of Q2? Perhaps, but is certainly a sign that there was an evacuation that happened over that longer period of time. Now, coming back, yeah, anecdotally, I'll see a down S&P 500 and I'll see, Apple, Amazon, Microsoft up and vice versa. What to make of that? I think I would guess that traders are going where they see the action's going to be, which has been, the biggest, I guess, rationale for why crypto has less energy than some of these other kind of sectors or subsectors right now.
Yeah, and I think that leads into the discussion that I want to have next with you, which really kind of touches on one of your first topics or first points you made: conviction. Where do you see conviction in the marketplace? We clearly were able to see conviction the last couple of years in the Mag 7. We are seeing conviction right now when it comes to AI stocks and anything adjacent to the AI economy. I mean, one doesn't need to look any further than, aside from just the market performance of crypto stocks, money flowing out of crypto ETFs so they can have more dry powder to get in on the SpaceX IPO, and then the Anthropic one and OpenAI's that are probably coming later this year, and buying into every stock in that market under the sun. And to your point about the rotations into the cyclicals, et cetera, and the idea of traders just focused more on volatility, but not conviction from retail, from like large buy and hold institutions. That certainly rings true to me. And I think that's a good segue into the crypto discussion, because again, terrific week. ETH is up big. Bitcoin's up big on the week, on the month. Finally, we're seeing some green shoots. But each time this has happened, especially during this crypto winter, it's fallen back. There was a brief relief rally, ironically, during the Iran conflict when it was in its heyday a few months ago. But that had a little more, I think, to do to perhaps gold reversing back to the mean, and maybe some crypto picking up a little bit of that slack, et cetera. And I am unsure if we're going to really see, for a real sustained uptrend, we have to be able to identify, where's the buying pressure coming from? Is it sustained? Are there real, almost like non-macro factors that are sort of unique to crypto that are going to help keep this going? Some evidence to me is promising. ETF flows in Bitcoin and ETH both ended 8 weeks of outflows with positive inflows, but they've been whipsawing this week. But in my opinion, too, it's also hard to have this discussion without thinking about strategy, where they sold almost 500, they tapped their ATM for almost $500 million, and they didn't buy one Bitcoin with it. They're just stocking up their cash to make sure they have enough dividend payments to handle their preferreds for the next couple of years. Metaplan is the same way. We're seeing DATs go out of business. So, that's one huge structural buyer that is sitting on the sidelines, at least for now. So I know that was a long preamble to me asking you a question, but I'd love for you to kind of react to what I just said, and what are you seeing, especially as you kind of monitor trading desks, how is the smart money positioning here?
Yeah, all good points. And we at GSR and within my vertical in GSR and asset management, we're just to comment on DATs first. I think we're pro DAT in that we definitely see how they can help complete the market for the combination of having a treasury that's focused on one digital asset plus native skill in trying to put that asset to work. I think, that takes a pretty unique skill set, and your firm and other digital asset treasuries who do this well provide to U.S. equity investors, we think, or have the potential to provide an interesting way to experience a digital asset allocation that has these kind of extra features. Strategy famously does this mostly through financial engineering. There are other ways to do it, some of which are more crypto native, and if they're done skillfully, they can be done in a way which meets investor objectives. And if they're not, then they'll be rooted out, and investors will vote with their feet from then on. In terms of what takes one of these kind of thin booster rocket rallies and actually like lets the vehicle continue to achieve altitude and velocity. The rally that we had last year, I think, was your kind of picture perfect model of a great rally, and Ether kind of led that rally in my view. It started with a very kind of concentrated long Bitcoin, short Ether kind of hedge fund or active trader position that when it began to unwind, right, Ether kind of came out with in a short squeeze. That was maybe step one, right? Step two is that crypto native people saw this happening, saw a trend starting to form, and piled in both in terms of spot, but also in terms of perps. And let's remember, all of the crypto market is somewhere between 2/3 and 3/4, depending on when you measure derivatives, and a quarter to a third in spot. So derivatives are fantastically important in determining where prices move. And then once the spot perp rally continued, that was stage two. And then stage three, you started to see, it's probably around May, June of 2025, ETF inflows, even to the point where Ether inflows were higher than Bitcoin ETF inflows, which was quite remarkable, right? Especially since they were newer and the relative size of the assets. And then, of course, you had this punctuation of the Genius Act being passed, and so many stablecoins rely on the Ethereum network to exist. So you had this kind of fundamental kind of extra boost. But I think that you'll be able to trust these rallies more when you see the new entrants, like layers of onion skin sort of start to participate. It has to start with a catalyst. For Ether, this year's catalyst may be all of the fundamentals linked to the formation of all these kind of foundation spinoffs. It actually might be a narrative and fundamental basis why Ether is outperforming in Q3 other majors pretty solidly, right? And then you want to see accumulation. You do need to have a little bit more volatility and energy and leverage in the market for that perp layer to really kind of create some lift.
What do you?
That's what we've been missing, I think.
Yeah, and I didn't mean to interrupt, but where do you think that money comes from? Like who are those participants? Is it normal trading desks that perhaps have been sitting a little on the sidelines that get back in because they have a conviction that they want to express? We're talking right now, the stablecoin supply has dropped about $10 billion since May, which is not a massive number in a $300 billion plus market, but it's not nothing. And it's the largest sort of drop since the Terra Luna collapse, which is something that we all kind of remember too. So that's dry powder that is going away. So this all just kind of goes back to my one question: like, who are going to be those structural buyers? Is it the DATs? I mean, for all the reasons that you and I just discussed. I mean, right now it's difficult with the vast majority of them trading it and NAVs below 1. It's dilutive for them to tap ATMs and issue additional common shares. Doesn't mean they won't necessarily do it, but it does complicate things a little bit more. We're not seeing any sort of government strategic reserve, which I know had been discussed for a while, and it still seems that a lot of attention from perhaps the ETF buyers that would go into crypto is still going into AI, looking for some of those soft spots. Maybe not the direct AI plays, but now the adjacent ones that perhaps have a little bit more room to catch up. So, I mean, all of this setup, and we're going to talk about Clarity. I know you mentioned a few of the offshoots from the EF that have come about, and those are crypto specific. But like if there are one or two people watching, listening, like one or two signs to suggest that like this is going to get some momentum. Like, what are you looking for, or is there anything interesting that you see come across your desk that makes you sort of change your forecasting?
We look at it constantly,
Mm-hmm.
and I think actually you brought up an interesting point that the DATs, especially the DATs outside of Bitcoin, I didn't mention them in that narrative about that kind of very textbook rally of last year, where you had
Mm-hmm.
constituent after constituent coming back in, because DATs at that point were still a little bit new, right? You wouldn't, you would think about traders, then you think about spot and pert buyers on centralized exchanges, then you think about the ETF flows starting to reverse, and et cetera, et cetera. But DATs would not only kind of slide in there as buyers who I think would participate sort of, let's say, in the middle of momentum, right? Because the shareholders would get excited, and that would help create the policy momentum for more token purchases to happen. But there are also holders that would be structural and sort of more permanent, right?
Yeah.
Because ETF holders now famously, right? That's not permanent capital. That's not permanent
not even
ownership,
a little bit,
right?
no.
Not even a little bit.
And just look at the last 8 weeks. It's very
precisely.
impermanent. Yeah.
Correct. And I think that brings out another point when we talk about ETFs and multi-token ETFs. There was another one that came to market today, and those being investment products, we're still in this market where you're dealing with traders. And I guess your question of who is it going to be who kind of really kind of gets the altitude of a rally going and creates more reliable momentum. Momentum traders will pick up on things pretty quickly, but momentum signals now have been frustrated for so long that I think a momentum signal, and this is exactly kind of what we're measuring with our kind of ambivalence and conviction kind of gauges, right? Which we've used externally a few times. You really need to see that a momentum cycle is in place. Once I think people feel that it's trustworthy, and that there won't be enough Fed surprises or geopolitical surprises, or other regular political surprises to ruin things, I think it'll be game on, right? I think we can exit the ambivalence phase as meaningfully and assertively as we've entered into it. But maybe that kind of consensus event type rally was the strongest of them that felt like it was going to be strong enough, but it wasn't. I think for the people listening who are just waiting to get in, it's I would almost rather join a rally that you feel really has legs, and be patient and be more comfortable not getting a bottom price, but getting a more healthy momentum rally.
Yeah.
So our quantitative signals that we use both for our ETF product and for our institutional absolute return products, they're certainly not solely momentum driven. There's a whole library of signals that we use, but a lot of those signals, or at least some of the sections of signals, are geared around this kind of how sustainable is this energy that's flowing into the market. So to sum it up in one word, it's all about energy.
Yeah, that's a good point.
If there's enough energy, and this is where kind of the booster rocket kind of metaphor feels very comfortable. If there's enough energy to create that altitude to get you into space, you'll be fine. But if there's not enough energy, you won't. And I like to measure energy in terms of volumes of spot and derivatives. I like to watch funding rates. More recently, I've really started to like to watch DeFi rates, because DeFi rates are an excellent kind of leading signal of who needs leverage, like who is borrowing money to go and buy stuff.
And what are
I-
they telling you? I mean, have you seen anything in like changes in put call ratios, DeFi rates creeping up? Is there
I
anything?
think it's simpler than that. I look at in my old seat. I spent a lot of time looking at Aave rates, and we had published this kind of SOFR rate for Aave, which
Mhm.
basically compounded Aave rates into a daily rate, and published that. And these rates went over 20% the month after the president was elected, and now they're right around where the risk-free rate is, where the yield curve is out, from SOFR to 1 year. So they're all, they're all around whatever 3.75% to 4.1%. So there's no there's no credit spread basically for DeFi
Yeah.
over money markets,
And it doesn't seem like people are anxious to lever up, is what you're
precisely
telling me
right.
right now.
And the most fascinating thing about that is imagine a situation where Warsh, gets up and he has a particularly strong cup of coffee. He's feeling great. He says, "You know what? I'm going to do my first surprise, and I'm going to lower rates." Right? Not going to happen, but let's pretend. Right? The market would love it. Asset prices would love it. Bitcoin price would most likely love it. And what would happen? People would go on Aave and start borrowing. Right. And since those are supply demand pools, you could see this situation where fiat rates go down and DeFi rates, not only Aave, but every vault on Morpho, every Steakhouse vault, every Gauntlet vault, everything on Veda and Concrete and all these platforms would shoot up because there would be this acute rush to lever, right? And leverage, whether you do it by perps or by borrowing to loop your spot holdings, is really, that's what's going to just kind of shoot prices up pretty high to the level where maybe, okay, that triggers some ETF inflows, maybe that triggers some DAT purchases, maybe that actually triggers some longer term holders from getting involved, and then you have a good market. So, but in the meantime, if you're looking at DeFi rates and they're kind of hovering around where SOFR to 1 year treasuries is, it's hard to see. That just means that supply is just pounding into these platforms to say, give me any yield I can get, right? Those interest rate models are just supply demand linear or stepwise linear functions. They're very, very simple. The more supply, the lower the yield. The less demand, the lower the yield. So if you see these rates hovering around risk-free, that's low energy.
Yeah, fair enough. Okay.
A very easy thing for people to monitor, and given all the new and exciting fixed income products in the DeFi world, there's a very rich, way to examine how these things are moving and changing.
Gotcha. All right. Well, we have a lot more to talk about, but before we do, we need to take a quick break to hear from another one of our sponsors.
If you hold crypto on your phone, your biggest vulnerability isn't your wallet, it's your carrier. AT&T, Verizon, and T-Mobile have been breached again and again, and SIM swaps are still one of the easiest ways for attackers to drain accounts. That's where Cape comes in, America's privacy-first mobile carrier. Same premium service, but Cape rotates the identifier on your SIM every 24 hours, deletes your call and text metadata after a day, and protects against SIM swaps with a 24-word recovery phrase that only you control. You also get 2 middle-to-end encrypted secondary numbers for banking and signups, so you stop handing your real number to every app that asks. Go to cape.co/unchained and use code UNCHAINED for 33% off your first 6 months. Heads up everyone, we've now fully transitioned Bits and Bips to its new dedicated channels. So if you're not yet subscribed to the new Bits and Bips channels on X, YouTube, Spotify, Apple Podcasts, or wherever you get your podcasts, go there and subscribe now. For the next few weeks, we'll play segments of the full interviews on Unchained as a reminder, but for now, you'll only hear those short segments of Bits and Bips on Unchained, no more full episodes. You can get links to all of the dedicated channels with the full episodes at unchainedcrypto.com/bits and bips, spelled BIPS. Thanks again.
All right, welcome back. So I'm here with Andy Baehr, and we were talking, as we went to break, you were talking about one of the signals that you pay attention to is DeFi rates. And if you start to see them ticking up, that gets it's a signal that people are looking to lever up again, there's bullishness in the marketplace. But right now, I mean, I think you were talking about Aave in particular. You're seeing a lot of lending pools operating at like the quote unquote risk-free rate, which suggests that there is not a lot of conviction, a lot of energy in the market. But then you also sort of teased us a little bit by talking about some of the new fixed income products out there that are available on chain. There's more and more coming. And you also talked about vaults too, which is sort of the new hot thing in DeFi, and I think a more sophisticated way to sort of engage in like algorithmic trading activities on DeFi. So I'd love for you to just kind of expand on where you were going a little bit more, and talk about how some traders are using these products, and then I guess how people should read into what's happening there vis-a-vis DeFi rates to get a sense of where that conviction may stand and how that could change.
Yeah, for sure. If you think about how most people interact with crypto assets, most traders, right? I think around the world, and I mean, it can be retail or it can be small institutions. Many will buy and sell a token, right? On a centralized exchange or on a decentralized exchange on Uniswap or something like that. You'll interact with derivatives, right? You'll trade perps, perpetual futures contracts, or you might trade options somewhere. All the asset-based stuff, right? All the stuff that really feels like more like equities or commodities in the traditional world. Those models don't really lend themselves that well to trading, to creating a fixed income market, to creating a money market, or to create a yield curve that's parallel to what happens in the world, in the traditional world. And of course, that's critical, right? So much of that, real funding rates, borrowing rates, things like that are handled over the counter between bilaterally across counterparties. There have been a number of attempts over many years, really fascinating projects, and gotten to know some of the folks who have tried to launch these in decentralized finance. But there's kind of, there's no other side, right? There's no investor base. There's no kind of broad money market fund experience that you can have the same way that you would have with your dollars or your other fiat currency. And that's starting to change a little bit. And unlike the centralized exchange world, right? The Binance, Coinbase, Crypto.com, Kraken kind of world, OKX, Bybit world. It feels like DeFi really is doing its best now to come up with great solutions for fixed income. Yeah. And little by little, they're gaining a little bit more mind share, a little bit more adoption, a little bit more credibility. And you just kind of start to realize that DeFi is a place where a lot of these fixed income ideas start to make a lot of sense, right? And fixed income people are going to just be rolling their eyes because I'm making such simple, very basic, bringing feeling statements. But there's no central bank. There's just supply and demand. It's a funding market. The money market doesn't have giant institutions that are kind of, LIBORing rates or doing overnight repo trades to sort of inform what the SOFR rate's going to be the next day. It's just people instantaneously buying and selling. It's the most decentralized and kind of organic thing you can imagine in the world. And little by little now, it is forming into these kind of clusters of activity that are giving us a sense of what the rates on stable coins, both for borrowing and lending, should be. And it's super exciting. And you just the idea that you can look at Aave rates and you can map them against crypto volatility or crypto prices and see patterns, that are related. To see, for instance, look at Aave rates back in April when the market was super ambivalent, super weak. The rates were super low. Nobody wanted to borrow. So the proliferation and the adoption and the kind of hardening up of a lot of these platforms for raw supply and demand of DeFi rates is super exciting. Vaults are a fantastic wrapper, which allows, among many other things, curators or managers to go in and identify these individual pools of borrowing and lending, put them into a portfolio, and have that portfolio emit a token which represents ownership or an interest in that pool. it's a money market fund if it's chasing short-term rates or whatever other portfolio is inside the vault. It's that equivalent. Of course, it's not a fund. Of course, it's not a security. Of course, most of it's not regulated, but it's 24/7. It's at least on a global perspective, broadly accessible. And as long as people do their homework and know what they're getting into, um, they're very efficient products. And it's just exciting, I think, that DeFi is finally kind of finding a little bit of purchase, not so much in playing the Bitcoin, Ether, Solana game, but saying, playing the money market game.
Yeah, it's vaults are really interesting to me, for a number of reasons, and your whole answer certainly gives a lot to chew on. I mean, for one, I found your comments kind of interesting. Like vaults they're not asset managers, they're not securities, so on and so forth. I believe there's some language actually in one of the versions of the Clarity Act from, I think, the Banking Committee's Act, where I don't remember the exact verbiage, but I think they're trying to sort of say something to that effect. And I think hopefully within Clarity, we're going to get broader clarity, no pun intended, for DeFi, but for vaults in particular, because because I could unfortunately see an administration that might be a little bit more crypto adversarial, trying to make the argument that these entities should be registered as broker dealers or something like that. So hopefully we'll get clarity on that. But
that's right. But it's not terrible, by the way, Steve, not to interrupt you. I don't see it as, I see this as, faith is earned slowly and broken very quickly, right?
Sure.
I think that what's probably most encouraging is you're starting to see certain platforms, right? And when you think of the stack of a vault, you have a technology provider.
Yeah.
You have curators, which more or less are asset managers of pools of things. They're selecting which things go in the vaults. You have the primitives, which are the things that they are putting in the vaults, right? Which might be an individual Aave pool or an individual Morpho pool or something like that. And then you have the underlying things which fuel those pools, and then you have the people who are going to buy the vault.
Yeah.
So you have all these layers, and it's actually kind of laid out in a way which I think is more dispersed and more sustainable than some of the other kind of structures in crypto right now. But from the point of view, and we being asset managers in my vertical at GSR, I think of the curator position as being one where you have a fiduciary-like responsibility to generate an outcome and to owe disclosure to vault owners, whether that's maybe that's just my CFA kind of code of ethics and standards peeking through. I think you owe that whether it's inscribed in law or not. Money market funds are securities. So I do think the growing up process is going to be some kind of reckoning for what standards curators should be expected to maintain.
Yeah, I think that's a very fair point. The other thing you mentioned that I just wanted to briefly touch on was sort of the idea of creating like a real sort of like yield curve for crypto. It's sort of, I see that almost in the same way as like how ETFs have brought in like the more traditional buyers, where in a certain way you could actually dampen the volatility, but perhaps like open up sort of like the aperture of companies that could invest because it's more predictable. So it's sort of like, who are you trying to go after? Like the volatile momentum traders or the longer buy and hold institutions? And there's sort of that tug of war that might play out, especially in that particular case. So I just wanted to mention that because it's pretty fascinating to me.
It is entirely fascinating. I think, if you the longer you look at, and I spent a lot of early 2025 thinking from an outsider's perspective about how decentralized borrowing and lending pools work. And, those rates they change instantaneously. It's not daily. It's not by the minute. It's once per second, or every time the pool changes, the rate changes. So even getting a daily rate requires some manipulation, and then having a reliable yield curve where you could actually think about an interest rate swap market or some such basic structure is important. Fiat is blessed with a number of different ways to look at interest rates, right? Swap market, treasury market, money market, and DeFi rates have I think, green shoots of those, but they are not standards which I think go across different firms or different
Yeah.
platforms. And that's what I would love to see happen. Yield curve and credit curve, those would be two essential components of a fixed income market maturing in DeFi.
Yeah. All right. So we're just about at time, but I do want to touch on the other big topic of the day, Clarity Act. As Yogi Berra once said, it's starting to get late early. And as we're speaking right now, I believe there is a meeting happening at the White House between President Trump, his chief of staff, Susie Wiles, some Republican senators that have been involved in negotiations, and I think Kristen Smith, the president of the Blockchain Association. And they're really going to try to hammer out some sort of agreement on ethics, which is a key, I guess, a key linchpin to get any sort of democratic support for the bill to pass. For anyone watching who's not familiar with the legislative process for this type of bill and most Senate bills to go into law, you do need to get 60 votes, which means that I believe you need at least seven Democrats. One version of the Senate banking bill got out of committee on a bipartisan basis, but the two Democratic senators who voted for it said that they more or less voted for it in good faith to continue negotiations on things such as ethics, and that their votes on a full floor vote are not guaranteed. And we're actually awaiting a new version of the Senate bill any day. A few sources I talked to said it could be as early as tomorrow, or maybe more likely on Monday. But I mean, this would be, if this meeting goes well and there's a way forward, and then it does look like we could see Clarity get passed into law before the August 7th deadline. I mean, that would be the catalyst for the rocket fuel that you were just making. And in my opinion, I mean, no one wanted to go through all the tumult that's been involved in negotiating this very comprehensive bill. But maybe the silver lining is that at least this could be one bullish instance where it's not a buy the rumor, sell the news, because the rumor has been, I guess, quote unquote, dissipating, and the news could come quickly. So this won't necessarily be a repeat of when Coinbase went public in 2021. Perhaps it's more like when President Trump actually became president. That's when the market kind of crusted. Maybe it's more like when the ETFs went live, and I guess it was January 2024. Is that when? I always get my years mixed up, but I just wanted to get your thoughts on. I know you're not a policy wonk. I think this isn't what you do, but I'm sure you're seeing traders positioning for all sorts of outcomes here, and this one is binary, and it could be coming up soon. So what are you saying?
Well, in the long term, it would be really important to get legislation passed, and it's painful to think about any time that the industry or other industries might have wasted in the past to get us where we are today. You're right, I'm not a policy wonk, and we do have some really smart and sharp people at GSR who have a much keener sense of the details. My kind of, zoom out take is the longer something takes to happen, the less chance it'll get done. We're in a time period frame now where we need almost zero distractions and a pretty solid tailwind to get that much done in 3 weeks. Poly market odds were at 75% in May, and now they're around a little under 40%. I think, and they've come down kind of linearly, which just speak to this. Every day that it's not done is a day wasted. The ethics question, it's hard for me to not think of that as a delicious political nugget that some people want to kind of wrap up and take home with them to eat another day, to point to the president's personal interests in digital assets, and of course the disclosure a couple of weeks ago that he's made well clear of $1 billion between himself and his family is red meat for the Democrats. It's important that it gets done. I do think at this point, the reason that it would be a good support for the market is it would be a surprise. I do think the market would take it as a surprise that passage takes place. It's not going to be a, yep, thought so, no big deal, we expected this. I don't think it's priced in right now. And so surprise is one of the most powerful, I guess, emotions that can help fuel either up or down moves in prices. So passage would be a surprise, and I think it would be hard to imagine a market that doesn't experience some lift.
Yeah. All right, great. Well, I think we have to leave it there. So thanks for everyone for joining me and Andy Baehr on Bits and Bips, the interview. But don't go anywhere. Laura's up next on Unchained with Johan Kurbat of Robinhood, digging into the launch of Robinhood Chain Mainnet, the rise of its meme coin mania, and what a brokerage running its own on-chain rails means for everyone else. And finally, don't forget, you've been getting these market breakdowns week after week on the Unchained channels, but we're on our own channels now, and the old feed won't carry them anymore. Subscribe on the Bits and Bips X and YouTube pages, plus hit follow on your favorite podcast platforms so you don't miss a single one. Thank you, Andy, for joining. We'll have to have you back again soon. And
thank you so much. I'm going to go update my feed right now. Make sure I keep getting my Bits and Bips.
Excellent. And thank you, everybody watching. That's it for us, but stay tuned.
MetaDAO has a pretty opinionated take on this, which is that voting doesn't really work and that you need an alternative, and we use decision markets. I mean, I guess to break apart the problem, voter turnout is not intrinsically an issue, right? The